Are you looking for a new option trading strategy that is both extremely safe and provides high yield returns? Sounds too good to be true, right? I just curated this new strategy that I call the Double Dividend Strategy. It combines all my 10 years of option trading experience, including all my research while I was working at Goldman Sachs. And when I tell you this is genuinely one of the easiest strategies for retirement income, I'm being 100% serious. So if you want to learn how to collect 2 to 3 times more dividends than regular dividend investors, watch till the end of this video. You see, while working at Goldman Sachs, I read an internal article about turning stocks into bonds that discussed an effective method of mitigating stock market risk while also providing income. Now, I thought this was super interesting, but only later did I realize that I can squeeze more out of dividend stocks and basically make them into near risk-free returns. If we were to rank how safe all these strategies that I cover on my channel are, this is probably the next safest above buying boring treasury bills that yield just a few percentage points. Lately, they've been more than usual, but still, you need at least 10% per year to really have a decent retirement. However, there is a big caveat. This strategy is more ideal for my multiple 5-figure investors and beyond. A small account can use Double Dividend Strategy, but in my opinion, this is the most ideal for the safe passive investor looking for high yield and low risk. Someone ideally that has a good job, that can save money every single month and contribute to their portfolio, snowballing it into a big passive retirement account. That's what makes this such a perfect retirement strategy. It can grow your account, snowball it to the point where it starts to take care of you. Now look, here's how it works. Stocks move up and down, making or losing you money depending on how much they rise or fall. One of the biggest risks to owning stocks is they can fall in value, causing you to lose money. Nobody, and I mean nobody, including Michael Burry, Warren Buffett, or Cathie Wood, can accurately predict the market. So instead of just owning a stock with downside risk, you can turn that stock into an income producing asset by selling a call against it in a special way. So the first step is you either buy 100 shares or you already own 100 shares of a stock in your portfolio. Now, to protect the downside, you pick a strike price to sell a covered call option. Say the stock is at 100. If you sell a $90 covered call for $12, here's what happens. You made $12 and you can't lose any money unless the stock falls below $9 per share. Say this option is 3 months until expiration. For 3 months, if the stock bounces around, it doesn't hurt you in any way unless it goes below $9 per share. That means even if the stock fell down by 10%, you would have literally zero effect on you. In fact, a 10% fall yields you $12 that you collected. This is how you build in downside protection while generating yield at the same time. Now check this out. If you own 100 shares of a stock paying a 3% dividend and you collect 3% premium from the call that you sell, now you have a double dividend in just 3 months. And you can do this every single quarter. You've turned the stock into a high yield safe bond that pays you a dividend and you collect premium selling call options. So, what's the safest and fastest way to retire and break the 4% rule that all the financial advisors talk about? They say that you can only take out 4% per year because that's a safe withdrawal rate. Well, I refuse to believe that. For me, I've grown my portfolio into 7 figures and I've consistently been generating passive income. So I don't believe the 4% rule, especially with option trading. So here's how you break this rule completely and double your retirement and do it much faster. Here's how it works. Imagine you want to retire and live comfortably without running out of money. The 4% retirement rule, by the way, is like a simple guide that suggests how much you can take out from your savings each year during retirement without running out of money. So say you were managing $500,000 in your total retirement savings. According to the 4% rule, you can withdraw 4% of your initial savings. So 4% of $500,000 is $20,000. But $20,000 isn't much these days and you can't even survive, which is why the double dividend strategy with options is the only way the average person can retire without having to work past 65 years old. If you can withdraw 4% under the normal stock market, then why not aim for 4% from stocks and at least an additional 4% from options? I've been averaging 4% per month, but of course, if I want to reduce my risk and guarantee I never lose, I could drop my return goal all the way down to just 4% per year in stocks and another 4% per year in options, or even 8% per year, because that's really not asking for much. I've been having over 30 36% to 48% returns per year on average. So asking for an 8% return from options and a 4% return from stocks is 12% return per year. Now, if you can consistently do that, that gets you into a much faster retirement. And 8% return consistently without having to even worry much, if at all, about a stock's performance is really nice. Because most years, even though the stock market does return 10 to 12% even, on average, of course, in some years, it does go down. So many investors that are in their retirement have trouble relying on the stock market for their retirement. Even though they may have $1 million and they can withdraw, a certain percentage of income, they're still worried. What if that capital goes down? What if my equity goes down? What if the market pulls back? But with a double dividend strategy, this really solves multiple things. You don't have to worry about the stock going down because you have a covered call that's providing you a margin of safety, and you have income coming in from that covered call. Of course, I made over 50% per year, and I'm just talking about 12% a year guaranteed returns. But of course, nothing is truly guaranteed, and I'm not a financial advisor, but I read this from leading banks that I've worked for, and in my past many years of experience, actually a decade now, I've seen that this really works. I combined some of these strategies with my own intuition, and basically I came up with this double dividend strategy. I use it on stocks that already have a high yield, like AT&T, Verizon, JEPI, ExxonMobil, Altria Group, KeyCorp, Johnson & Johnson, JP Morgan, Home Depot, Procter & Gamble, Merck. These are just some of the names that I trade. I'm going to tell you my favorite 5 stocks as well for this double dividend strategy. But first, if you sell a high delta covered call on a dividend paying stock, you can collect a double dividend in the form of premium plus owning the stock that distributes dividends quarterly. By selling a 40 delta, for example, you still leave room for yourself for the stock to appreciate in value, giving you a double dividend plus growth. Now that's really important because I know many people, they still want growth in their portfolio, especially if you're working with a smaller portfolio or a medium-sized portfolio. You still want it to grow, but if you had millions of dollars, you'd be more concerned with not the growth, but the dividend component in the income. But this strategy really allows for both growth, dividends, and income. This is how you leverage your money safely for passive, consistent income, which will secure your retirement 2 times faster. So ask yourself, how much do you need to retire to live off of this strategy? Do you need $120,000 per year? Well, then you would need $1 million in savings, which can sound like a really big number, but you can also get there pretty fast if you're investing, saving, and compounding your wealth. Is it really as much as you thought? Or could you live a lifestyle that you desire with some hard work and savings these next few years? I've tried just about every single investing technique. Strategy, I've tried active jobs, I've tried passive investments, I've tried swing trading, I've tried so many things. And with this, I see no downsides and only freedom with this strategy. So here's what you need to know to make no mistakes. But before I go over that, you need to have as much information as possible on your list of long-term plays, because there are tons of dividend paying stocks out there, but they're not all built the same. You need to pick good dividend stocks that have really good safety, a good payout ratio, and consistency in growing their dividends. So let's go over my top 5 favorite stocks. The first stock is Bank of America, ticker symbol BAC. Bank of America has faced headwinds in 2023, including bank runs and increased capital requirements, leading to a discount in its stock price. This actually makes the stock even better because the lower the price goes, the higher the dividend becomes. The current dividend sits at 3.51%. The market cap is a little over 200 billion and the price to earnings is around 7. The bank has been a major beneficiary of higher rates, which is evident in its net income growth. But like nearly all banks that had very few investment options on their massive excess reserves, Bank of America did misfire by adding too much duration when rates were incredibly low. That's why the stock is currently trading at such a good value and providing a very high dividend yield. I currently have 500 shares of Bank of America and I'm selling covered calls for the double dividend strategy myself. Although US households are running out of money and all signs point to a retreat in consumption in the next months ahead, I believe that Bank of America's strong brand will position itself favorably against competitors. Next dividend stock I'm running this strategy on is Kraft Foods. The company has done well reducing debt in recent years, but their low 5.4% ROIC, or return on invested capital, makes it hard to meaningfully leverage returns for equity investors. Despite the slow growth, the cash flow of this company is very strong, and the stock price is the cheapest it's been in a while, and the company is stagnant at 11.7 forward price to earnings ratio. This means that investors are not paying much for growth. A According to 13F filings, Berkshire Hathaway, both Berkshire A and Berkshire B, still owns 422 million shares, or around 34.5% of Kraft Heinz stock, unlike YouTubers, hedge funds, and financial advisors who have ulterior motives and incentives to lie to you. Warren Buffett runs a company that doesn't take any fees from investors, doesn't sell any programs, and doesn't have any reason to convince you or show you why he's investing a certain way. So his positions are the best to pay attention to. The dividend yield of the stock is 4.7%, and the PE ratio is well below the S&P 500. The company's growth strategy in emerging markets is showing promising results, with double-digit growth and a focus on building distribution capacity and infrastructure. You can see here all the brands that they own. I currently have 700 shares, and you can see the multiple different covered calls that I have. The next stock is Intel. Over the past year, Intel has traded very predictably. It has stayed within the Bollinger Band and rallied heavily after dipping just below $25 per share. It's currently trading at the middle of its Bollinger Band, which to me looks like a low-risk opportunity to pick up shares and collect dividends while selling covered calls. The dividend isn't as large, but the stock is growing. With a booming AI semiconductor market, Intel is one of the few firms with a diverse enough portfolio to serve multiple needs in the AI revolution. And if you guys watch this channel, you already know that I really like technology companies, specifically Apple, Google, Microsoft, Meta, and other really large tech companies, because they have significant alpha over the market. And for this company, as you can see, the dividend safety is really good, and the company's track record for paying consistent dividends is excellent. That's what I really like about Intel. I currently own no shares, but I plan to buy some. Realty Income, ticker symbol O, is the only stock with monthly dividends. Cash flow growth for REITs has been very strong and should remain strong. A REIT is a real estate investment trust, and this sector, along with option trading, will give you the ability to provide safe passive income. And this is actually the #1 reason that I don't really own any real estate, because I don't want to have the headache of managing anything. Realty Income gives you real estate exposure. They have an A-rated balance sheet. That means the dividend is likely to continue compounding and paying bigger dividends every quarter. And stability is something that's very important that I look for in a dividend company, especially for running the double dividend strategy. For REITs, I like to use the dividend discount model. This is something that I learned back when I was studying in university and getting my finance analytics and accounting degree. I typically like to be a little bit more conservative than other analysts in my valuations. Realty Income Corporation offers a high dividend yield of 6.3%, and I actually have a 3% growth rate in place, and I believe that a 40 delta covered call plus the monthly dividends will easily get you double-digit returns per year safely. Next stock is Pepsi. PepsiCo's ticker symbol is PEP. Right now, the stock is going for around $160 per share. The 1-year price chart is up and down, but generally it's trending and compounding higher. The EPS is $6 per share, over 3% dividend, and the market cap is slightly over $200 billion. The average analyst price target is $189.72 with a rating of 2.4, between a buy and a hold. They recently introduced a new logo, which hasn't happened for over a decade. I believe this could help its brand in attracting extra attention. Pepsi is a duopoly with Coke, but I think the valuation on Pepsi makes more sense at this time. PepsiCo's Q3 results showed strong operating margins and an 8.8% increase in organic revenues, despite modest volume declines. The company's strategy of selling smaller packs has helped meet consumers' demand for portion control and mitigate negative consequences of price increases. PepsiCo's international business, particularly in India, performed well with significant profit and revenue growth. The forward PEG ratio is very reasonable. That's why the double dividend strategy at around a 40 delta and 60 to 90 days out is a great strategy. Let me ask you, would you rather have a safe, consistent return, or would you rather have a more aggressive return at a higher risk? If you want to see how to multiply your money with other option strategies, make sure to check out my playlist on screen right now.